webinar is designed to assist you in your review and understanding of Unit 5 of the Dodd-Frank Preparation course. This unit will review material from 5.1 covering housing counseling and the mortgage industry. Let's start with a quick review of the different categories of housing counseling that are recognized by HUD. HUD has divided the types of housing counseling into the following: pre-purchase counseling, mortgage default and foreclosure prevention counseling, financial management for homeowners, rental counseling, homeless counseling, home equity conversion or HECM counseling. Traditionally, the topic of housing affordability has been marketed toward lower income clients. I think we do now realize that middle class and upper income clients could also benefit from information regarding the topic of affordability. I think that the last housing crisis did show us that getting into an unaffordable situation happens to all of us and is not restricted to any particular group. So target audiences often are people in households earning up to 80% of the median income, ethnic minority communities, and special needs households such as single-headed households, but housing affordability does affect all of us. This slide shows you an example of how we use income and family size to determine where someone falls in the range of area median income. And you'll see this abbreviated as AMI. So for example, if you're working with a family of 5 and they have an annual income of $50,000, you can see that they fall above the 50% but below the 80% of the area median income. In order to understand more about the topic of how housing affordability is defined and regulated, let's start with a discussion about the SAFE Act. In 2008, government approved and passed the Secure and Fair Enforcement Mortgage Licensing Act, otherwise known as the SAFE Act. This act was amended in 2010 by the Dodd-Frank Wall Street Reform and Consumer Protection Act. We will be discussing each of these in more detail in the following slides. Let's start with a discussion of the SAFE Act, the Secure and Fair Enforcement Mortgage Licensing Act. The purpose of this act was to combat fraud and enhance consumer protections related to loan originators. State licensing systems were put into place to require that loan originators had the necessary integrity and knowledge that they needed to perform their jobs. Specifically, the Act requires that in order to obtain a license as a loan originator, the applicant must demonstrate that he or she will act honestly and fairly, they must complete courses, and they have to pass a written test on federal and state laws, ethics, consumer protection, fraud, fair lending, and standards in the non-traditional mortgage product marketplace. In 2010, what happened is that the Dodd-Frank Act was passed as a response to the financial crisis. The general goal was to create a sound economic foundation to grow jobs and protect consumers. It was also hoped that it would rein in Wall Street and end bailouts and prevent another financial crisis. So the part of the Dodd-Frank Act that addresses housing affordability set out to establish minimum standards that must be met before a mortgage could be approved. These minimum standards were designed to ensure that a consumer has a reasonable ability to repay the loan. This act also created the new Office of Housing Counseling within HUD. The act was drafted by Senators Barney Frank and Christopher Dodd and became law on July 21, 2010. As I just mentioned, the goal was to avoid another financial crisis by focusing on establishing regulations to protect consumers. Many of you who have worked in the housing industry for a while now may be familiar with what we used to call no-doc loans. Prior to 2010, lenders were offering mortgage loans to individuals without requiring them to document income. These loans typically carried an above-market interest rate because lenders were well aware they were a higher risk loan. Under the Dodd-Frank Act, these are no longer allowed to be considered a qualified mortgage loan. We will be having more of a discussion in a few slides about what defines a qualified mortgage loan. Housing affordability. Well, when I first read this definition, I have to say that I thought this is how counselors always determined the definition of how to determine availability. But the Dodd-Frank Act did spell it out for us. So, the Dodd-Frank Act specified that loan repayment must be based on the borrower's credit history, current income, current employment status, the monthly mortgage payment, property taxes, other debt obligations, and the monthly debt-to-income ratio. So for those of us in the housing industry, we've always said that the loan approval should be based on these things, but it took the Dodd-Frank Act to actually spell it out for everyone. Let's move on to the discussion and the definition of what makes a qualified mortgage. In order to be considered a qualified mortgage, lenders have to comply with the ability to repay rule. On the next slide, we're going to go over the definition of a qualified mortgage. But basically, you should know that the definition was put forth to get rid of the risky loan terms that we used to see in the mortgage industry. What are the requirements and what does it take to be considered a qualified loan? Well, the features of a qualified mortgage are defined as no excess upfront points and fees, no interest-only loans, no negative amortization loans, no loans with terms longer than 30 years, debt-to-income ratios must be less than or equal to 43%, no loans with a balloon payment except those that might be made by a smaller creditor in a rural or an underserved area. Also prohibited would be certain types of prepayment penalties. The next thing that the Dodd-Frank Act did was to amend the Homeownership and Equity Protection Act. You may recall, or you may have heard, that this act was passed back in 1994 to address abusive lending practices. It was passed because we were seeing lots of predatory loans with high fees and high interest rates. The Dodd-Frank Act gave us some specific definitions to work with regarding what constitutes a high-cost loan. So let's talk about that. We finally got some definitions to work with. And this way, we were able to define what are the characteristics of a high-cost loan. It would have an interest rate that is 6.5% or 8.5% above the average prime rate, excessive points and or fees being charged to the consumer. Some prepayment penalties may cause a loan to be considered a high-cost mortgage. So, if a lender does offer a high-cost mortgage, the Dodd-Frank Act established some requirements. First of all, no balloon payments. If any of you have worked with clients that had a loan with a balloon payment, you know how dangerous these can be. Second, no prepayment penalties. This used to happen all the time. Lenders would give someone a loan with horrible terms and a very high interest rate, and as though that wasn't enough, they would write into the contract a penalty if the homeowner tried to refinance and get out from under the loan before a certain length of time had passed. The next item is that if it is a high-cost mortgage loan, no points or fees can be financed into the loan. And to the final point, creditors may be required to establish an escrow account under some conditions. Now, let's move on to a deeper discussion about how lenders are required to establish that someone has the ability to repay. Let's start with income. Borrowers have to have it. What a novel idea, right? The lender has to verify that the applicant has adequate income or assets to repay the loan. Furthermore, if the lender is counting on employment income, the lender must consider and verify that employment. So typically a lender is going to require verification of employment covering a 2-year period. The monthly payment that is considered has to be the full payment. And when I first read this definition, I thought, well, what else would you use? And then I realized that lenders for years had been basing approval and calculation ratios on introductory rates and teaser rates. And I'll give you an example of this that actually happened in my state. I live in an area where we have a lot of farmland, and this farmland frequently gets sold to builders who put up neighborhoods. Well, during the housing boom, these builders were throwing up houses on the farmland, and in order to sell as many houses as possible and to get as many homeowners qualified as possible, the builders were offering a buy-down term for the mortgage loan, and they were offering to buy down the interest rate for an initial period. So for example, one builder was offering a 3-2-1 product. So the first year, the interest rate was 3 points less. The second year, 2 points less. The third year, 1 point less. And then the fourth year, it adjusted up to the full rate. Now, they sure weren't doing this to be nice. They were doing it so that they could qualify folks on that artificially low introductory rate and sell them a bigger house. So what they would do is to max out the ratio, even though they knew that in the first 4 years of home ownership, the homeowners would be facing a substantial increase every single year. What compounded the problem in this particular case was that because these homes were new construction and they were being built on farmland, the taxes didn't adjust for 1 year. And then after a year, the taxes hit them and they had a huge increase in their mortgage payment. I was a housing counselor during this time, and I saw family after family coming in for counseling. I felt like I could set up shop on the street corner of some of these neighborhoods because I was seeing family after family that lived on the same street because they had all built their homes during that same time period, and all those adjustments were hitting them at the same time. So the second bullet point addresses this. Lenders have to include all mortgage-related obligations in the ratios. This means taxes, insurance, everything has to be included. And if they're doing a second mortgage or a piggyback loan, they have to count that too. A qualified mortgage, in order to be counted as a qualified mortgage, they should not have a debt-to-income ratio higher than 43%. So when I was counseling in these neighborhoods that I was talking about, it was not unusual to have someone come in after that very first interest rate adjustment, and they were at 70 or 80% because of that payment increase and that property tax increase. Current debt obligations, alimony, and child support must be considered. Lenders are given some flexibility in this area, and they may use reasonable means to consider other debt obligations. The creditor has to calculate a debt-to-income ratio using the total of all of the mortgage as well as the non-mortgage obligations. In a few slides in the next unit, we will be giving you some examples on how to calculate these ratios, and we're going to be reviewing how to calculate the front-end ratios as well as the back-end ratios. In addition to everything else that we've discussed, lenders must consider an applicant's credit history. This does not mean that they must use a specific report or even set a minimum credit score, but it does mean that credit history must be considered in loan approval. And as I mentioned, the full loan payment must be considered in the ratio calculation. So if the lender is doing a second mortgage or a piggyback loan, it must be considered in the approval. This concludes our discussion of Unit 5.1, Housing Counseling in the Mortgage Industry.